Hey everyone, welcome back again. This is the Gift team, and we're here bringing you a summary of behavioral finance. So, we just kind of want to talk about with this video opportunity to cover some of the basics with behavioral finance, what it does to traders, what does behavioral finance have to do with the markets, and kind of understanding behavioral finance and what it is in order to use that to our advantage. Now, kind of a little bit of behavioral finance and what it does to traders. Now, I just want you to think of kind of concepts of what is going on when you're a trader and the psychology that goes through. Actually, it doesn't even matter if you're a trader, if you're an investor itself, because during times when we have high volatility, that isn't actually really the markets doing anything. That's the underlying investors or traders playing it out and I would say kind of exaggerating what is actually happening. Now, kind of a couple of things that come into mind is 2008 when we had the financial crisis. Although, don't get me wrong, the financial crisis was as terrible as they said it was, causing a liquidity crisis. The one thing that people don't like is uncertainty. And I think the main thing with financial crisis in '08 was that no one knew who had the bad mortgages. So we had a credit freeze and banks stopped lending each other money. And that's when you had to have the government come in. So with that being said, all you hear, if you're, let's just say you're a regular investor, all you hear on the news is, oh, the markets are going to crash, this and that, so much uncertainty. A lot of the times is people rather be safe than sorry, I guess, and they rather sit in cash. So when you have portfolio managers or investors doing a sell at whatever price, at market price, that caused a flood of negativity and price action or price pressure onto the stock or the markets itself. Then you see a crash. And that crash was one of the biggest crashes we had. And we had a drawdown of about 50% of the markets. Another one that comes into mind is the cryptocurrency hype. So in 2017, I remember a friend was helping his grandmother buy Bitcoin. And at that point, when you know that everyone wants to buy something, you had a market that was essentially $100 billion market cap jump up to almost $1 trillion market cap. That really is a sense of kind of everyone's flooding in. The greed emotion is coming into play. They want to get in. They don't want to miss this golden opportunity to get rich. So that's another side of behavioral finance. You have your fear, you have your greed. Um, so kind of the topics we want to make sure that gift does is bring to you or develop these kind of psychological skills and the mental fortitude to kind of bring to you that when things do happen, you can kind of bring yourself out of this whole picture and view it as the whole picture and just instead of one piece of it. So, kind of talking about kind of moving on to the behavioral finance and how it affects traders. So, the biases that we typically have with being traders here is that first biases is that what you hear, let's just say, for example, on the news about how I think was it CNBC does this incredibly well is that they have audience or they have guest speakers here that really ramp up stocks, or you have a Jim Cramer that's telling you to buy or sell. And that forms kind of an idea into your head that sometimes is not the best sense, because when they think about something, you don't know exactly what their underlying reasons are, right? You don't know how much of in their portfolio they're holding this specific stock. So if they take a loss on this stock and it's only 0.5% or 1% of their portfolio, it's not a big deal to them. But to you, if you actually went all in on that, then it is a big deal to you. So everyone is markets is very subjective. Whether it be the value of it or kind of when people talk about it, it's very subjective because you don't really know what their underlying investment ideas and how they're going to execute it is. Now, kind of on the topic of execution and kind of behavioral, I'll let Simmer take it away about behavioral finance in the marketplace.
Right, thanks. So behavioral finance in the marketplace, it's seen every day. Basically, we see it on a daily basis. We see it basically every month. Every time something big happens in the market, we can see behavioral finance acting in the markets. Influence and biases can be the source of most of these behaviors and market anomalies in the markets. We see it during the cryptocurrency hype back in 2017. when we had that huge bull run. Everyone thought it couldn't fail, and it ended up being a bubble, a parabolic, and it just ended up crashing after that. And then earlier this year as well, in March 2020, when COVID-19 fears happened and markets started to sell off pretty harshly, everyone started to sell off. Investors, hedge funds, retail investors, traders, everyone was hitting the sell button on that. So we see that with the herd mentality, and in 2008 as well, everyone started to sell off. That's basically the herd mentality in it, the fear caused in the market, driven by catalysts, and it usually causes a sell off all across all markets. We saw it during the COVID crisis with the foreign exchange sell off. Markets started to sell off, commodities started to sell off. Oil went negative for the first time ever, too, which is pretty interesting. So, fear is the main driver in these sell offs. Happens from like a top level all the way down to a lower level. And that's where we see the behavioral finance in play. So how do we see it in play in these examples? We see it in play because when one certain catalyst or issue happens, everyone starts to follow the herd, everyone starts to sell off, everyone starts to get scared, the fear starts to hit in, and that starts to go lower. And the same with the opposite way too. We can see that currently with Tesla right now. Tesla just keeps going up and up and up. No end in sight. It's on a rocket ship going up. We feel like that behavioral finance is in play in there currently because everyone seems like Tesla can't fail. And from recent events, it really can. It's just been going up every day, even after the recent split as well. We see it rise every day. So we do see it on a daily basis, even intraday trading as well. When we talk about the levels and zones that we do draw on our live streams, we see it on an intraday basis where if a level breaks, we do see continuation of it. Or even if something happens in the market, it's unforeseen event, like maybe Trump puts out a tweet saying that they're having another trade war with China or something, then we do see gold start to rise, and that is completely influenced by behavioral finance market. We do see investors and traders start to buy gold in there. So so that's an example of behavioral finance in the markets, and you really got to improve on those biases, really understand what this psychological side of the markets is in order to become a good trader. You want to see what the other player is doing, or try to understand why it's moving, what the smart money is doing, what investors are doing, and really to understand the markets on a psychological side, because there is a big mental and emotional gap when it comes to trading, and you really have to understand those in order to be a successful trader. And that drives us to our next topic, which is understanding behavioral finance. Um, and it's basically how to improve every day as a trader and really get a grasp and understanding of behavioral finance and its influential ways on trading. It's basically understanding why investors and traders make these financial choices, how these biases affect their mental state and their trading, and if they're emotional on a certain day, or if they had some unforeseen circumstances happen, how that could affect their trading as well. And with that, it's a, it's pretty important and necessary to really change your mental state and behavior in order to really understand that there are going to be losses associated with it. How can you learn from it? The developmental skills that go within it, how to how to improve the mental fortitude, mental toughness, how to improve your emotional gap, how to really close that and really trade based off analysis, probabilities, and understanding the players in the market. Everyone really says greed is good. And when you have that whole narrative that greed is good, it can bring a lot of fortune, but it can lose a lot as well. And if you get too greedy, you start to over leverage, maybe over trade. So that's just one example of the greed. There's a risk side too. People are risk averse, so they will never get greedy on a trade or an investment. So that really puts somewhat of a cap or a limit, because when they're risk averse, they don't like to lose a lot, but they also can make a lot. So really getting that balance, which we talked about in trading basics and investing basics, and taking that balance as well as understanding the behavioral finance side of it, and really getting understanding of your mental fortitude, mental toughness, and developing some skills that will improve the trading in the long run. So when we go more in depth, we do have these subtopics when it comes to behavioral finance versus developmental skills. We talk about our three main ones are the patience, consistency, and discipline that go into trading. But of course, there's other skills necessary to become a successful trader. And we do talk about those. If the topic comes up, we have a blog post on that. I know recently we did one on focus and how to focus on your trade, not to really get distracted by like a text message or anything, but to like really understand that there are two possibilities of a trade. It can go your way, but what if it goes against you? What are your actions? Or if you hit on the sell side and on the buy side as well. Mental fortitude is basically how the state of your mind really affects your trading. So you have to really train your mind to be in the right state of mind. It's the mental toughness that goes into it, not really taking losses as like an end all be all, but really learning and improving from those losses as well. So it's really about growth for mental fortitude, how to grow from these learning experiences, how to really take routine, schedule building, better habits, any aspect of life that includes building your mental fortitude will go under this subtopic and in the blog as well. And finally, biases. Everyone has their biases. Everyone pretty much thinks a certain way. They're really closed-minded, and these individual biases, the herd mentality biases, how it affects your trading, what overconfidence does, ego issues, not having a radically open mind. Ray Dalio talks about that too. That's why he's so successful, because he does have an open mind. He doesn't have any biases anymore, and he really does like to have purposeful engagements, purposeful disagreements as well. So then you actually understand both sides, and with that, you can understand both sides of the trade too. Like you might be biased towards the long side, but what if it drops? Could you profit on the short side as well? And we have the main blog here for behavioral finance that covers all those three subtopics. But if you do click on these links, you will get into more in depth, specifically on these topics and how to improve your trading. And with that, we'd like to thank you for tuning into behavioral finance video. I hope it helps your trading.
Thank you, everyone. Take care.